Welcome to the Deep Dive. Today, we are really cutting through the noise on Aeva Technologies Q3 2025 earnings call. This is a key player in the 4D LiDAR space, and while they are sitting at a fascinating crossroads.
Fascinating is the right word. You've got this incredible leading-edge technology on one side and some major commercial wins. But on the other side, you have this, just intense cash burn and massive capital requirements.
Exactly. So our mission today is to help you dissect this. We want to put management's very, very optimistic story up against the market's pretty skeptical reaction.
And figure out where the truth is, or at least where the opportunity might be hiding.
Let's do it. So let's start with the headline numbers, the results snapshot, because this is what really created all the confusion. Revenue came in at $3.6 million.
Which is a huge number for them. That's up 57% year over year, and it absolutely smashed the consensus estimate. Wall Street was looking for $3.1 million. This was a 15% surprise to the upside.
A 15% revenue beat. Normally it sends a stock flying.
You'd think so. And then you look at the non-GAAP EPS, a loss of $46 per share. That also technically beat the consensus, which was for a $1.47 loss.
Okay, so a top line beat and a bottom line beat. And yet the stock traded down sharply, down over 6% the next day on really heavy volume?
Exactly. The market completely ignored the beats. It was laser focused on something else entirely. It was looking at the ongoing losses and, the big questions around capitalization.
All right, let's unpack that because that's the core of the story. Let's get into the financials that had investors so worried. You're talking about cash consumption.
I am. The GAAP operating loss was $33.2 million for the quarter. Now, to be fair, they are showing some discipline. The non-GAAP operating loss was lower at $27.2 million.
And that's in line with their goal to cut full-year operating expenses by 10 to 20%, right?
It is, which is a good sign. But the gross cash they used in the quarter, that number was somewhere around $33 to $34 million.
Wait, hold on. So the non-GAAP operating loss is $27 million, but the cash burn is over $33 million. That feels like the market would see that expense cutting as a positive. Why did they ignore it?
Because the absolute number is just so big. When you're burning north of $30 million every single quarter, profitability is still, years away. So investors see the discipline, but they also see the enormous gap between $3.6 million in revenue and $33 million in cash going out the door. And closing that gap takes a very long time. And a lot of capital.
Which brings us right to the elephant in the room, the new capital raise. Management announced a big one, a new $100 million convertible note investment from Apollo Global Management.
And brand this, of course, as a huge vote of confidence, a sign that a sophisticated investor is backing their plan, extending their runway to go scale the business.
But the market didn't see it that way.
Not at all. The market sees a convertible note and immediately thinks about dilution. So the terms are a 4.375% coupon due in 2032. But the key part is the 15% conversion premium.
Meaning Apollo can convert that debt into Aeva stock in the future.
Exactly. So you add this to their existing cash and their equity facility, and their total liquidity jumps up to about $270 million. The runway is definitely longer, no question.
But the fear is that this is just kicking the can down the road, isn't it? Isn't this just an admission that the tech itself isn't generating cash fast enough to fund the business?
That's precisely how the market read it. The fear is that when that Apollo note eventually converts to equity, and it's designed to do that, a flood of new shares hits the market. Every existing shareholder's piece of the pie gets smaller. Their stake is diluted. So management is selling a story of flexibility and a longer runway. The market is hearing a story about future dilution and a capped upside. That's why the stock dropped.
Okay, that makes sense. A really powerful disconnect. But that financial picture, it contrasts so sharply with what management was saying about their commercial execution, which they called incredibly busy and productive.
And this is where the story gets so interesting, because they're not wrong. The execution is actually incredibly strong. The biggest piece of news is their work with a top 10 global passenger OEM, a huge automaker.
And they completed their joint development program for the Atlas Ultra sensor.
They did, and here's the kicker. They did it ahead of plan. In this industry, that almost never happens. That is a massive de-risking event for the technology and for the company.
And now they're in late-stage contract negotiations for a massive series production award. This would be for Level 3 autonomous driving. What makes this potential win so important? It can't just be the money.
It's not just the money. It's the technology shift this represents. If or when this contract gets signed, it would be the first time a major car maker switches away from the old legacy LiDAR, the time-of-flight LiDAR, to frequency-modulated continuous wave, or FMCW technology for level 3 driving.
So why is that shift such a big deal? Why has no one else done it? What can Aeva's FMCW do that the others can't?
Well, it can measure velocity instantly, down to micron level for every single point it sees. Legacy LiDAR can't do that. It gives you incredible data redundancy and just superior performance, especially in complex city driving. So if Aeva lands this deal, they don't just win a contract, they basically reset the gold standard for the entire auto industry.
Wow. So this becomes a reference design for everyone else.
A global reference design. The contract would cover multiple vehicle lines worldwide except for China. It's like the first domino to fall in the whole industry's transition to real 4D sensing.
That puts the momentum in a totally new light. And speaking of major programs, the Daimler Truck program is also moving along.
It is firmly on track. They are still the exclusive long and ultra-long range LiDAR supplier there. They've already delivered the initial sensors for vehicle builds, and they've received the first sample orders for the 2026 model. That 2027 market entry target with Daimler looks solid. It's just more proof that the tech is winning, not just in cars, but in heavy-duty trucking too.
And they're not just betting on automotive, which can be a really volatile cycle. They're diversifying.
A very smart move. They're pushing hard into what they call precision sensing. This is targeting the multi-billion-dollar manufacturing and automation market.
Right, the Eve sensor line. This is where that unique ability to measure precise motion and velocity really shines, isn't it?
Absolutely. They shipped over 1,000 units of their Eve 1D line, and they just launched the Eve 1V motion sensing line. This 1V sensor is designed for the factory floor. We're talking about micron-level accuracy, 1/1,000,000th of a meter. It can measure tiny movements in complex robots and machinery that traditional sensors are just blind to. They're not selling a sensor, they're selling precision itself.
And they're doing this without building a ton of expensive factories themselves.
Which is critical for a company trying to manage its cash burn. They brought their Eve production lines up in Thailand ahead of schedule by leaning on manufacturing partners. Just like they're doing with LG Innotek for the Atlas Ultra sensor, it's asset light scaling. They're essentially renting massive factory capacity instead of building it.
Super smart. And they also released something called AevaScenes.
Yeah, that's another Silicon Valley playbook move.
Yeah.
It's the first open access data set that combines their 4D LiDAR data with camera data. You give it away to developers, to universities, to researchers. You let them build on your platform. It seeds the ecosystem and creates this powerful flywheel effect where the whole community starts validating and building cool things with your unique data.
Okay, so let's put it all together. The commercial execution is undeniable. A top-tier OEM win seems imminent. Daimler is on track. The industrial business is scaling smartly. And yet the market just hammered the stock. If the business pipeline is so strong, what is the biggest overhang here?
It all comes back to trust. Trust in the long-term financial picture. And the optics were just terrible. First, you had notable insider sales from the CEO, the CTO, and the CFO right after the earnings and the Apollo deal were announced.
Oof, that is never a good look.
Never. Regardless of the reason, it sends a terrible signal when you've just raised capital that introduces future dilution. And on top of that, you have these broad sector headwinds. The ED cycle is choppy. We just saw Volvo drop another LiDAR supplier, so the market is pricing in just brutal execution risk for everyone in this space. No one gets the benefit of the doubt.
But that's the core conflict. Management is screaming about the technological wins and the commercial momentum, but the market can only hear the clock ticking on the cash burn, and they're seeing red flags with the dilution and the insider selling.
It's a perfect split, a battle between long-term faith in a technology and short-term demands for capital discipline.
All right, it is time for our not financial advice segment. We have to stress this is purely for analytical and intellectual exercise. These are high-risk, high-upside ideas looking at potential mispricings.
And the thesis for an aggressive trade here is built on that exact disconnect we were just talking about. The market has, arguably, irrationally priced in all of the bad news, the dilution, the insider sales, the cash burn, before the single biggest positive catalyst has actually happened. The top-10 OEM contract getting formally signed. Exactly. That creates a potential temporal mispricing, an opportunity for a very asymmetrical bet.
So what would an aggressive, event-driven trade actually look like?
Well, you'd want to use leverage to bet on that long-term outcome. So you could look at using long-dated, deep out-of-the-money LEPS calls. Think about something like the $17.50 strike calls that expire way out in 2027 or 2028.
So a very cheap binary bet that the OEM contract gets signed and the company scales toward those huge analyst revenue estimates of what, 800 million or $1 billion by the end of the decade.
Precisely. Those calls could offer massive leverage if that happens. But that's only part one of the trade. The immediate risk is still that dilution and selling pressure. Right.
Right. So how do you hedge that? How do you make sure the stock doesn't just bleed out before the good news hits?
You use the market's own skepticism to pay for your long shot bet. So you could partially fund those long-dated calls by selling a shorter-term, lower strike call spread. Maybe sell the $15 strike and buy the $20 strike with a 6-month expiration. That's a bet to capture the high implied volatility we saw right after earnings.
So you're harvesting volatility in the short term.
Yes. And at the same time, you could short a small tranche of the stock itself right around that $12.94 closing price. That's your direct hedge against more drops from dilution fears or insider selling over the next couple of quarters. The whole structure assumes the fundamental story eventually wins, but you're using the current pessimism to pay for the lottery ticket.
And of course, just to reiterate, nothing we just discussed is financial advice, strictly for analytical purposes.
So this was just a critical quarter for AEVA. It really defines the split of personality of the company right now. You have this incredible commercial execution, that top-10 OEM win on the horizon, Daimler progressing, smart industrial expansion. But then you have the market's severe punishment, which is driven entirely by that persistent cash burn and the reality of capital dilution. The market is betting the FMCW transition won't happen fast enough to outrun the balance sheet.
So that leaves a final question for you, the listener, to decide. Is that Apollo investment a true vote of confidence in a technology leader that's about to hit escape velocity? Or is it just more fuel for a very expensive R&D project that's still years away from standing on its own 2 feet? Keep your eyes glued on that top-10 OEM contract announcement. That piece of paper will decide everything. Thank you for joining us on this deep dive.